Hey friends, Lucian here with the Bullish Bears team. This video is going to be on how to place a put credit spread. Put credit spreads are also known as bull put spreads. Again, there's several different names for the same type of trading strategy in the options world. Gets a little bit confusing, but two of the most popular names for this strategy are put credit spread or bull put. It is a bullish strategy. So you'll see here I'm in my Thinkorswim platform. This is my virtual account because I'm going to show you how to place an actual put credit spread. So you'll see right over here, since we're going to take a bullish position on this, again, don't just randomly, when doing any type of trading, don't just randomly guess, right? You got to know your support, resistance, patterns, all that good stuff. But for the sake of this video, we're going to say that Facebook is going to stay above this kind of this 255-ish area before or by expiration. All right, so what we're going to do is we're going to look at this 255 area in an options chain and build a credit spread. So if you go over here into the trade tab, and what this basically means too is just to explain it easier, is that by expiration date, Facebook could go up, it could come down, it could trade sideways, but by expiration date, we want price to stay above 255. As long as it stays above 255, we collect the whole premium, right? Now, again, along the way, we suggest taking profits. Don't always just hold to expiration with any type of options contract, but especially credit spreads. Take your profits along the way. But in theory, again, when you're doing a credit spread, you want price to stay above or below your strike price by expiration. So on a put credit spread right here, you'll see we want price to stay above whatever our short strike is. If we were bearish on the stock, let's just say we wanted it to stay below that 297 area, that means if we took a bear call or a call credit spread, that by expiration, we want price to stay below our short strike. So if we were doing a call credit spread, we want it, let's say in this scenario, to be below that 297 area. With a put credit spread, we want it to be above this, let's say 255 area. So that's the theory of how this works or how it breaks down when doing credit spreads. You want price to stay away from your short strike by expiration. So now let's take a look at how you place a put credit spread trade. So again, we're going to look at this 255 strike. So you want to come over here to the trade tab and look down right over here, strike 255. Now we're looking on the put side. Remember, we are going to sell this to somebody else that's a buyer. So we are an options seller. So if someone is an options buyer, they would be buying on the put side. We want to sell that to them. So when we look at the 255 strike, you'll see right over here, again, probability of out of the money. Again, when you're an option seller, you want that option to expire out of the money as a seller. When you're an options buyer, you want it to expire in the money. So the probability of success on this trade is about 80% right off the bat. Again, don't take a trade just because it has 80% probability. You have to know your entries, when to enter, when to exit. But again, for the sake of this video, right off the bat, we have the odds in our favor. So what you want to do is just right click on sell vertical, all right? So right off the bat, there is about a $2.50 width on the strikes. Now, just to kind of go over again, if you want to make more money on your credit, so this is the credit that you'd receive, 38 cents times 100, which is $38. Before you go buying more strikes over here, or before you go buying more contracts, consider, again, widening your strikes to receive more of a credit. So this right here is a $38 credit. If I went to, let's see, where is it? 255 minus 5, 250. Now it goes up to a 70 credit, right? So I'd receive $70 rather than 38. If I go 10 width down, so 245, I'd receive $116. Now remember, it's important, whenever the more credit that you receive, the higher your max loss, so the more risk. Doesn't mean you take the trade. Obviously, you don't want to be getting yourself in positions of max losses, but just be aware right here, if you had a 10 with strike right here, the risk is $884 for the potential to make $116. Basically cut that in half for, almost in half. We'll just take a look. We'll do, for the sake of this video, 5 with. So we'll do 250. And you'll see it's about, the max loss is 431. Max profit is about $70. Again, you want to take your profits along the way and don't allow yourself to get those max losses. Again, it happens at times, but make sure you cut those losses and keep them small. But for this video, we're going to place this trade, and I'm going to show you what it's like, again, how to get into this put credit spread. If you want to know what it's called, you'll see in the broker right here in TD, it says put credit spread. And this red shows that it's sold. If this showed green here, that would mean that you're in a vertical spread, right? Or a called debit spread. So again, see, that's where the terminology comes in, right? So these are also called vertical spreads, right? So I can call it a put credit spread, a bull put spread. I can call it a vertical spread, right? Or a short vertical spread. So again, several different names, but the most popular, put credit spread or bull put spread. So let's just place this trade right here, and you'll see when I place the trade, it should fill. Again, it's usually pretty quick because it's in my brokerage account. It seems like TD today has a little bit of a delay, not sure why, but just to show you, if you want to speed it up when you're doing simulation, don't just do this in the real world, but if you want to make it fill quickly, well, it actually went real quick. I could have changed it from a limit order to a market order. But again, don't rush your trades in the real world. I was going to show you that, but it went and filled. So as you can see right here, I have a position right here of Facebook. When I open it up, you'll see kind of just the profit and loss kind of slowly move up or down right over here. But if you want to see the position, I just can open it up right here, and you'll see right down over here, I have a put credit spread, right? So this is my position right down over here. So I want to show you what it looks like to close the position. So just kind of opening it, you can see the different legs, the two different legs down over in here. But if you want to close the position, this is how simple it is to close it. You basically just right click, create closing order, and buy it back. Remember, you're selling it at first, and then you're buying it back with credit spreads. It's the inverse or the opposite of doing debit spreads or being a buyer. So if you buy something or you're doing a debit spread, you buy it and then you sell it to close it out. So with doing a credit spread, you sell it first and then you're buying it back. So you don't want to just rush in and out of orders. Normally you want to make sure you get the right fills, entering the order and also exiting. But for the sake of this video, we're just going to place this order to confirm and send it and get out. This is, again, a great way to practice. I can't stress it enough how awesome paper trading is, because this is a great way, especially with options and, there's lots of different moving parts. This is the best way to learn how to trade them, is by practicing, right? So again, if you come over here into the monitor tab, just to show you, when I open up right here, now that position is filled and it's closed. So that position is no longer in my brokerage account. So in the world of options, there are several different strategies you can do. Again, credit spreads, one of the most popular and also one of the best ways to grow a smaller account. So if you have a smaller brokerage account, using credit spreads, it's a great way to slowly, number one, learn how to trade options and also kind of slowly grow your account. So in our community, we teach all these different strategies in our courses. In our next level library, we show you what type of strikes to buy, which ones are most lucrative. We do go over all the different types of more advanced trading strategies. And we also do a trade alerts service. We do real-time options alerts, and there's, a great way to practice taking our options alerts is by using them in a virtual account. So again, our alerts are great for growing your brokerage account. We do great trade alerts. Again, we're not 100%. We do lose at times, but we keep our losses small. But not only, are they great for growing your brokerage account if, you want to follow our alerts, they're great for practicing and learning. So when we call out a real-time alert, what better way to learn than to take that alert and practice it right in your simulated virtual account? Practice it until you feel comfortable. Once you understand our trade alerts and you understand options and which ones are the best fit for you, then you slowly scale your way up trading with real money. So hopefully this video on put credit spreads helped you, and we'll see you in our community. Enjoy.